Welcome to Timeouts with Victor on Financial Modeling Bootcamp. This is a free bootcamp where we will be taking our undergraduates guys on financial modeling. So we're going to teach them the concept, the basic and the mechanism of financial modeling. So we hope they'll upskill and they can stand out by the time they graduate from their respective institution. So welcome to Time Out with Victor, and let's appreciate our support and let's also recognize some important community. So I currently work with Deep Brown Consulting, so I must definitely I recognize their support, and also a Microsoft Most Valuable Professional, which is more like the recognition given by Microsoft themselves for being good at what you do and for your community service. So let's get straight into it. What are the things we'll be covering in this our session today? Before you jump into anything, it's always good you understand what is the story behind this skill or this profession, right? Because that kind of give you that storyline, and you can always use it to relate to any problem. And in doing that, the truth is, irrespective of the business you do, or right, the industry you fall into, you must always have business cycle and accounting cycle. It exists irrespective of the type of business you are doing. So we're going to now use that to create a business concept, and we don't have some interesting group activities. So let's get started. Why financial modeling? How did it start? Now, from onset, after the creator created the whole world, it kind of gave some set of people benefits, some advantage, right? Due to some guys have some resources more than some other places, right? You go to the country, one has oil, another one we have wheat, another one we have cocoa, just like that, right? So which means you are in, you have your own place, I have my own, right? Which is more like, hey, I kind of have my own neighborhood. You have your own neighborhood. You have something that I want, right? And I also have something that you want, which means what do we need to do? Then we need to look for one guy that can connect us together, right? And it all started from the early days, which means what I have and what you have, we can actually exchange it. And that's where the whole story of business operations started from. In fact, the whole world up to today, that's what we do. So they usually do trade by barter. Later, they had to introduce cowries and coins. In fact, they were using gold, right? Different thing. But the whole concept is they had to look for something as a means of doing that exchange better. And that's where the money came into play. It was all about a transaction. I have something, do you have this? So right, which means if I have $100, right, it means someone has actually created something and said, hey, this money can buy this and this. So money was now introduced. This was going on for a while. Then on the part of the accounting, one guy now came in and said, "Well, you know what? We need to start documenting all this transaction." And that is when our wonderful Luca Paciolo around 1494, right, came up with our bookkeeping. And we have different source documents, right? As an accountant, I'm quite sure you know those source documents that we use in doing our recording. Then there was now additional thing. As I said, it's all about that transaction, that operations exchange between one neighbor and another neighbor. Then tax had to come into play, which means one town can go and colonize another town, right? Maybe because I have this, I have assumed to be, I have power, right? I have resources that I can use in getting something. So they will colonize another neighbor that maybe has the kind of thing they need, and then after colonizing them, they will now tell her, hey, you know what? You need to be paying us something. Call it percent, they call it cut, they call it tariff. I also think that we have some other names that we also use for this, right? Some say, hey, okay, pay homage, right? Different terms that we use under that. Then after that, then came the introduction of modeling and spreadsheets. The truth is, there's no way we'll talk about financial modeling that we will not talk about spreadsheet, which is our Excel. So a while ago, we had one man called Bricklin, right? I think he went for his either PhD, right, or doctor's degree in finance, but he has this technology skill as well. So they gave them assignments, and the assignment is this. They asked them to kind of do an investment evaluation. So they say, okay, you know what? So let's assume you have $100 today and want to invest it in this business, right? What will be the return in the next 5 years? Now that you know that you can just do it manually, do your calculation. Then I say, okay, what if, what if? So we are investing in this business and we expect 12%. What if the return is 10%? What if the return is 5%? Which means you need to start doing the calculation for each of the scenarios. So now the guy now felt like, you know what, there should be something that can make this thing very easy, such that we build the input, we do the calculations, and we have our output. And all we need to do is to just change that input, and the calculation automatically calculates to give us the output. That kind of make things easy instead of doing the calculation. So which means if you have 10 scenarios, you need to do different calculations to be able to get that. Then the guy now called on his colleague, Bob Frankson, said, hey guy, you know what, let's build something. And that was where they started with this CAC, right? I'm quite sure you know the story of computer. Before we now get, so from there I think we had Lotus as well before we got to where we are today, where we use our Microsoft Excel. So, which means you as a modeler is always good to understand this story. The one, the host, the whole what? That's what we keep doing today. There's always that exchange. One neighbor asks what the other neighbor don't have, right? So it's either you will try and do that trade by barter, or you go ahead, you take over them and they to be paying you homage and the whole thing, right? So money was introduced. That means, oh, if you're saying I want to invest in this tomorrow, there should be a way, right? Because that's where the whole story of money comes into play. You now use that money to make more money. You use that money to acquire more power, right? More value that can take over what others what they have, because that's the whole story. Now let's take a look at what we call business cycle and accounting cycle, because you need to understand this as an accountant and a finance expert or a tax expert, irrespective of this professional skill you are in the finance world. It's all about business. Now, there's one guy called Cash, and Cash is king. Trust me, Cash is king. And to the finance guys, cash is a means of measuring return on any investments. Even though accountants we tends to be more concerned with profits, but on the finance, cash is very important. And when you are valuing a business, the cash element is what we believe is still the best, because you cannot separate it from the business. You want to go and take a loan in the bank, they will not look at your profit or loss account. They are more concerned with your cash, because you can actually make up your profit or loss account due to our accounting accrual basis. But your cash is either you have it or you don't have it. So this cash is very important. And now, usually that cycle usually starts with what we call operating assets, because that's what you use in generating revenue, irrespective of the business you do. Now you need to understand that assets is assets. Okay, assets are assets, or asset is assets. It could either be a current or a non-current asset. It could be your property, plant, and equipment. It could be your investment security. It could be your cash. It could be your inventory. As long as you are using that asset to generate more revenue. So, for example, for a manufacturing business, right, their operating assets will be those plants and equipment they use in doing their production and their inventory. So, the more inventory they sell, the more product they sell, the more revenue they can generate. The more those plants and equipment produce, the more they can sell. For a bank, their own operating asset is more of loan, because the more loan they give out, the more interest income they can generate. Now they convert this into revenue. They try and manage their costs to have a profit. Now, in our income statement, you can only have three things. And when it comes to data analysis, categorization of your line item is always into that three parts. It's either is a revenue line, or an expense, or a profit. So when you deduct one from another, you always have a name of a profitability line item. Then from there, you now convert that into cash. So profit is different from cash. A business can be profitable and cash deficit. You can read more in that aspect. Now, when it turns back to cash, you don't just leave cash idle. You need to invest it back into the operating assets. And this is what we call operating. Uh, this is what we call our business cycle. And irrespective of the type of business you do, this cycle is still the same thing. So the more cash you start to put it back into your operating assets to increase your revenue, generate uh, uh, generate revenue, right? Deduct your expenses and you have your benefits. Now, on the part of the accountant, what is their own role? So under that operating asset, hey, we are going to record it in our balance sheet. Operating assets, so balance sheet is very, very important when it comes to business operation, because it actually shows us the book value worth of the business. The profits, where you have that in our profit or loss account, where you record your revenue, your expenses, and you have your profitability. And the cash will be recorded in our cash flow statement. And that is the same cycle. Now, on the part of the finance is also concerned with this three cycle as well. Number one is sources of funding. What is the best capital structure? The best funding mix. So you see that under our non-current liabilities and our equity. What is the best source of funding that has a least cost of financing, but will give us the highest optimized results? On the part of the profit, is all about market penetration. So you want to increase your revenue, you want to gain the market share, you want to have most of the customers buying your product. Different strategies on how do we increase our revenue, how do we manage our cost, what is the effect of macroeconomic effects on our expenses and our pricing of our product. Then on the cash, they now use that in evaluating the business returns. That is the whole thing around what we call our business cycle. Now let's take a look at how this now flow into our financial modeling and how we apply this story. Now, how it flows into financial modeling concepts, and this is one thing I want you to, one skill that I want you to develop. For you to be a good financial modeler, you need to have a sense of storytelling. You need to be able to create that picture in your head before you even get started with Excel. Now, let's see how it flows into the financial model. And this is one thing I want you to do first. Assume any business concept. Just think about any business concept, anything. In fact, you could decide that, hey, you know what, I want to be selling pen to people. Any business concept, right? And now, let me now ask you, what will be the first thing that you need to do? Definitely the first thing that we need to do is we need to do a market research. Hey, this is my product, this is my business model that I have in mind. Is there a market for it? If yes, what are the things that can affect it? Oh, maybe there's a government policy, maybe there's industry policy, there's sector policy, right? Hey, do I think people are interested in this kind of thing? What are the macroeconomic and general effects, things that can affect my business, right? Hey, definitely your business, there's no way your business can operate more than the period in a year, right? More than the days in a month. So those are the things you need to consider. After then, right, then you do your visibility study, create your research document, right? Do your business plan and all those things. Then you now move straight to you getting your funding. You now start considering, hey, what type of funding, type of funding am I going to use, right? What sorts of funding are we using? Is it loans? Is it equity? And you now need to also consider the cost of getting that financing. Or maybe you just prefer that, you know what, I'll go with my own personal contribution as investment. Then you now need to tell us, what are you using this money? What expenses will it cover? Definitely, you need operating assets. You need to do your business registration. You need to get some furnitures and fittings. You need to get some plants and equipment. You need to get inventory, raw materials, right? You need to make provision for working cash, your capex, capital expenditure on your equipment as well. Then after that, you now get started with the business operations. So you employ people, you set up your office space, then you start the business operation. You start generating revenue. You need to manage your cost efficiently so that you can have a good profitability stand, which is a means of measuring how efficiently you've managed your resources. Then the last part of it is you now generate that cash, which form a base for evaluating that your business, oh yes, I'm profitable. This is more like additional cash that I've been able to generate on the initial capital outlay. Now let's take a look at another visualization of this business and accounting cycle. Set, you always start with your market and economic research, right? You consider those factors, and from there you get your financing, your investment. And after you've done those two, then you now do what? You go straight to your operating assets, right? Your capex, furnitures, your capital expenditure, get those assets that you'll be using in generating revenue. Then you need to make provision for your working capital, which is more like your working cash. The fact that you start a business today does not mean tomorrow the business will be able to generate a revenue or a cash that can sustain itself. So which means you need to have some cash. You need to make provision for some cash that you'll be using, right? It could be maybe 6 months, it could be 3 months, right? You need to employ people, start paying them, do some expenses, subscription, and do so, which is you need a working capital cash. And then you start generating revenue, you manage your cost to have your profits, right? And then convert that profit to cash. Now, this is the cycle and it exists irrespective of the type of business you are doing. So let me give you an example. Let's say Apple. So they've created iPhone, let's say iPhone 11, right? So they've done the economic research. Okay, we need to get this product out. They've been able to get the financing, could be from their own pockets as well, right? Then they use that in getting operating asset. Hey, get this raw material that to put the phone together, right? Have some working cash in pushing the market, create awareness and all those things. Then they start generating revenue, manage those direct costs, cost of creating that product. They have that profit, then they have that cash. Now they don't just leave the cash idle. What do you think they will do? Oh, you know what? Let's use it to start up another product. So it's related to business, it's also related to product. Okay, you know what? Let's create a iPhone 12 or iPhone 11 Pro. Then that means that becomes they do another research. Oh, this is the financing, this is what we need, this is what we are going to use the money to do. Invest it in the operating asset, and that cycle exists. Right? As a modeler, you need to understand that. Now, let's look at another visualization into the model, which we are going to use to create a sample business case. So, model, business model and cover. So, let's assume we want to create a business and it's for a distributor. Yes, so the person will be, so the business, what they'll be doing is they'll be buying beverages, right, and they'll be selling it to retailer. They buy it from the manufacturer, so more like a middleman distributor, right? So let's assume that's the business. So the first thing is we need our general macroeconomic assumption. So let's practicalize this. Let me open a blank Excel and let me share that with us. So the first thing we need is what we need our what? So let me zoom out. The first thing is what we need is our general and macro macroeconomic, all right? Macroeconomy, is it economy or economic? Either of the two, right? But let's macroeconomic assumptions. So let me put this in our heading one, right? If I can reduce, let me reduce this font. Let me also reduce this column. So let's first discuss the general assumptions. So under the general assumption, what are the things that we need to consider? Number one, there's no way your business can operate more than the months in a year, right? Based on our law, tax, and some other things, it's always more like a 12 month thing. So if I let me put that unit here, so let's call this month, right? And this will be 12. So let me put this in our input sales type so that we know that hey, these are hard coded value. And here, let's say days in a year. About the days in a year, right? So days in a year, let me put these at days. Then how many days? So let's even say 365 days, right? And what is the effect of this? So let me give you an example. Let's assume I'm saying I have a product, right? And I'm saying how many quantity can we sell? So let's say quantity, right? Quantity per month. Okay, let me just call this quantity, right? So let's call this quantity. Now we are saying, hey, per month we want to be able to sell, let's say 5,000 quantity, right? So now, which means by the time we put this in our inputs, we are building a yearly model. So which means we need to convert that monthly to yearly. And to do that, what do you think will be the simple calculation? If you're saying we'll be selling 5,000 every month, basically that will be 5,000 multiplied by what? By this 12. I'll press enter. So which means we have yearly. Okay, we'll be selling 60,000 units yearly. What if we now decide to even break it down? So let's say we want to have it as days, right? So let me delete these two guys. So let's assume we want to be having it as days, and we're saying, hey, you know what? We can sell 25,000 units, 25,000 quantity, right? Uh, daily, right? In fact, let's now look at let's look at this. Let's call this operation. So let's say operation days in a week, right? So let's try and break things down. So operation days in a week, and we say, hey, you know what? Let's assume we'll be working Monday to Friday. We say, hey, 5 times 4, let's say 4 weeks. So that will be more like 20 uh, uh, days in a month. So that means to convert it, that will be this 25 quantity that we said we'll be selling per day multiplied by what? By my operation days in a week. Okay, so this should be a month. So this should be in a month, right? In a month. So just for you to understand that, you can go as granular as you want, right? It depends on how you put together your assumptions. So which means I'm saying to get my monthly quantity, that will be my daily quantity multiplied by what? Operation days in a month. And to convert that into year will be my what? My monthly sales quantity, my monthly quantity multiplied by what? The month in a year. And we have this. Right? And that is how you can go granular. So that's more like the effect of this on our business operation. So you can always have others, right? Just to give us an example. Then the second one is what we now call the second one is what we call our macro, our macro, our macroeconomic economic. Is it economic or economy? Yeah, just either way, right? So economic assumptions. So let's say the first one we need to consider inflation rate. So let put this in percent. So right, then put it in our input sales tax and put that in percent format. So let's say our inflation rate is on 5.5. Right, what will be the effect? So let's assume I have an expense here, and I'm saying, so let's say I have year one, year two, year three. I'm saying in this my year one, I'll be spending 5,000 as an expense, and I'm assuming this 5,000 will be for the 3 years. Now, I could be right. Fact, this is more like factor of budgeting. Oh, Wells budget will be spending 5,000 this period, then 5,000 another period. The highest thing is you say, "Okay, you know what, let's add like 10% for to increase the budget and all those things." But modeling is like the umbrella of it all. You try to remove human input. So I say, okay, yes, we agree that you might be spending 5,000 for each of the respective period, but the truth is we need to consider time value of money, because what 5,000, that put your currency, what $5,000 or 5,000 naira can buy today might not be able to buy it tomorrow. That's the whole thing about time value of money. So we are saying, okay, yes, this is good, but you know what? Let's factor in inflation, which is more like the driver of increase in cost of things. So we're saying equal to my last year multiplied by, open my bracket, 1 plus this my growth rate, which I'm going to keep constant. Close the bracket, enter, then drag that. So which means you're saying, previously you're saying, hey, 5,000, 5,000, 5,000, but with the effect of inflation, you say, hey, you'll be buying 5,000 in year one. In year two, which means you might need to pay more for it, and year three, you might need to pay more for it. So if you take a look at this as the difference, which means this is my base minus this, my current year, and also this one, my base minus the current value. So which means in year two, we need to make provision for additional 275, and in year three we need to make additional provision of 565. So that's the effects of that. So let me delete this just to show you an example. Then the same thing, we also need our pricing rates, right? So for the pricing rate, let's just put that as something like 2.5. We say maybe half of our inflation. At times inflation can increase, but price might not increase as such, because there are a lot of things that drive price, right? Number one, you can't sell higher than what your competitor are selling. So there are a lot of things around that. So what other things? So we also need our corporates. Let's make provision for government, right? With our tax rates, because you need to pay tax. So for this one, let's just assume something like 32%. So you could have some other things. For example, we make use of GDP or say, hey, there's no way your business, there's no how good your business will that we exceed the GDP of a country. But to every rule there's always an exception. And one thing you also need to understand that a 10% increase in a company like Coca-Cola, or a 2% increase, cannot be compared to a startup business that is having 25% increase, right? So those are the things you also need to understand. So the company that has 5 billion in revenue, and they increase by 5%, that means 5% of the 5 billion being added to their revenue. And a company that is just starting and has just a million, and they say, hey, we are increased by 25%, you really cannot compare that. So that's for the general one, right? Which is the first thing. So irrespective of the model you need to build, you must be able to create that storyline. Then the next thing is you now need to get your financing. So let's look at that. Let's take a look at that. So I'm just going to copy this guy. I'll put it here. So we call this our financing assumptions, right? So let's first get our funding. So let's assume we'll be making use of loans, right, and equity, right? So this will be our total funding. This will be our total funding. So let me just put my currency here, right? Yeah. Um, let me put my currency. So let's just put some. So you're just putting some fictitious assumptions so that you understand the whole story and how we apply it when we are building our models. So loans, let's say 5 million. Okay, let's even say loans of 3 million, right? So let me expand that. So let's say 3 million, and this 2 million, right? So then the summation will give us 5 million. So we have that. Then the next thing is you now need to consider our cost of financing. So for our loans, what are the things that we need to have under it? Then we need to have our interest rates, right? So let me work smart. Let me just copy this guy and let me put it here. So our interest rates annually, let's say this is 11.5%, right? I'm just putting some fictitious assumption. Then loan period, we need to consider loan period. So let's say this will be in years. All right, let's assume they will give us the loan for, let's say, 5 years. Then for the equity on, number one thing is dividend payout ratio, right, which is more like this form of profit sharing to the owner of the business. So let's just put this as 30%. Then we now need to have our cost of equity, right? So we go deep into this later in the session, but let's just put it as 25%, right, or 20%. Cost of equity can most times is always high, or we call it order rate. So which means we have our assumption on our financing. Right. So let's look at the next thing in our cycle. Then the next thing is, let's now discuss how we plan to make use of the funds. So let's call this financing and use of funds assumption. So here I'll just call this one use of funds. So which means, so let's take a look at things that we need. Let's take a look at things that we need. So number one, you need to get licensing for your business, right? You need to get licensing and registration for your business, right? Then the next thing, you need to get your property. So you need to get your property, plant and equipment. So if you prefer, if you want to break things down, you can always break it down. So I'm just giving us more like an high level thing, right? So your generators, okay, maybe you should just have a vehicle here, a vehicle, all right? You could also vehicle. You can have some generator, some intangible assets, and all those things. So we can summarize everything on that property, plant, and equipment. But at times you might need to break it down as well. Then we need to get our inventory, right? Inventory or raw material, right? So you definitely need to do that. Then you need to do some marketing and advertising, creating awareness of your product, right? Then the next thing, you also need to know what we have some prepaid expenses, right? For example, your rent, your insurance, you prepaid some subscription fee that you need to do. You also prepaid. Then you now have your working, so let's call this operating. So you need some operating cash that you'll be using in running your business. Now use the total fund. The total use of fund must always be equal to your what, must always be equal to, so let me just copy this guy here, must always be equal to your what, to your uh funding that you are raising. So which means by the time you do this summation, it must always be equal to this total funding. So let me put this, so always equal must always equal to total funding that you are raising for that period, right? So I'm not going to put anything there, just to give us an overview. So now that we've itemized this, the next thing is working capital and operational cost. So we can put this both of them together, revenue and cost. Now times two years when people build model, they usually start with revenue, because revenue is more like the umbrella of the business, because that's where everyone is eating from, right? But I just want us to understand the story flow, right? So that you can, well, by the time you start, we get into the modeling part, you kind of understand how this relate and how it flows. So let's do the, so working capital, operational cost and revenue, we are going to call both of them operations. So let me just copy this guy. So we're going to call both of them, we're going to call them operations. So let's call this operation, and the first thing is revenue. So under revenue, number one, we need our product pricing. So let's assume we'll be selling Coke, right? We'll be selling Fanta, Sprite. Then we could have other products. So, right? Then let's put this. Let's assume this will be selling per pack, since they are distributor, right? So naira per pack, right? So for three of them, four. So we have four products. So I'm just going to put some random fictitious assumption. So let me say this is 1.5, right? This is 1.450. And this is 1.4000, and this one 1.300. We have that. Then the next thing is, what is our product cost, more like our cost of sales, right? Cost of sales. What are the direct costs? So let me just copy this guy. We also need the price per pack. So let's assume this will be one, let's just call this 1.3, right? Right, 1.3. So what will be this one? So 1.250. Just as I said, just some fictitious assumptions, right? So that you understand the whole story. Then after that, we need to now have our quantity, our quantity, our quantity as well, right? So let me just copy this. How many units are we going to sell? So let's assume we'll be selling pack, uh, number of packs that will be selling per month. So let's assume we have this per month, right? The average unit that can be sold in a month. So for Coke, let's assume we can sell maybe 5,000 packs in a month. Coke seems to sell faster. And this maybe 4,000. This other one 3,000. This other one two, let's say 2.5, right? And just to have that. Then the next thing is, what about our operational cost, our operational expenses? So we should call it expenses, right? We could have our salaries. So for the salaries, you could decide to break things down and say, hey, number of staff that they're going to have, average salary for each of the staff, and all those kind of things. You could decide to break it down. As I said, this is more like an high level thing. So you could have some rent, right? You could have subscription that they will be doing, subscriptions. You could also have some utilities. They could have some professional or some legal commitments that they need to do, some office supplies, right? And just and so they could have some logistics, right? And some other miscellaneous expenses that they will have. Then they can put that. So you can put that more like an expenses monthly, right? So as I said, I'm just giving us an overview. So this should be naira per month. So more like a monthly operating expenses. So you can always put your own fictitious assumption. Then after that, the next thing is our operating working capital, right? Operating uh, working working capital. So on the part of the asset, we are going to have our trade receivables, right? Trade receivables. We could have our prepayment. Okay, before that, we need to have our inventory days. I think inventory should even come first. So inventories, okay, maybe inventory or inventory, let's call it inventories, prepayments, right? And then on the part of liability, so let's call this current assets. This should be current assets, right? And this should be the current liabilities. This will be our current liabilities. Then we're going to have our trade, our payables. All right, we could have our accruals, then some other liabilities. Right now, what the whole concept uh, around this operating working capital? So most time we usually use this, and what they're saying, hey, inventory days. Any any of our product that we have in our store or on our shelf, we should be able to sell it within a stipulated period of time. So in the typical corporate world, that's more like how they kind of do it. That, hey, you know what? Hey, please give us this your product, and within this also period, we'll be able to pay you back. Right? If they give their product to a customer, they tell, hey, you need to pay us within this so number of this. So it's that same concept that we use. So inventory, any stock that we have, we should be able to sell it, let's say within 15 days. Must not stock must not stay on your shelf too much, right? Trade receivables, any client we sell to, we must be able to collect our money fast, right? Let's say within 20 days. Let's give them 20 days. Prepayments, most expenses are being prepaid like 30 days ahead. Even though you pay your rent at the beginning of the period for the whole year, we still need to account for it yearly, right? So trade payable, which means any of our suppliers, we also need to be able to pay them. Let's even say 25 days, right? Accruals, anybody that we need to pay part of our operating expenses that are due, we should be able to meet up our liability within 20 days. Other liabilities, let's just put 30 days. And this is more like the approach that we use in creating this, right? And then we now do our calculation. So that's how we apply this in building our own financial model, and how that story kind of tied together. So we've created the business concept. Now this time for your own activity. And this is what I want you to do. Discuss and agree on any business concept. Now, create assumption for the business using that business cycle that we discussed. And I've given us a sample, a demo of it as well. Make sure your own is realistic, because you might need to do a research to be able to get your values, to get your assumptions correctly, right? So that will be your own activity, right? You need to be able to do that presentation. You could do it in Excel or also create it in PowerPoint. Just make it interesting to create that story. You should be able to tell us, hey, this is what I've done in the research. I think there's a market for this, and this is the reason why I want to start this product, and all those things. Then you go straight to here, and these are the things that we consider could affect our business. Do your SWOT analysis, pest analysis, and all those related things there. And these are, I'm getting my funding, this is the business revenue operations, and you just put the whole story together. And that is the end of our session for today.